Welcome. Welcome. This is the breakout that's looking at exploring sustainable energy trade and climate solutions. And we've got a couple of excellent questions that we'll be exploring in this session here. We're going to be looking at how businesses can take proactive roles in addressing climate change through innovative solutions, while also navigating regulatory and reputational risks. And we'll be looking at financing the green transition, so how businesses can play a pivotal role in financing energy trade and climate initiatives to ensure long-term sustainability while balancing profit with purpose. Now, ultimately, a really core question that we'll be delving into is the role of transition planning in all of this. And we've got a couple of fantastic speakers to set the tone for all of this here. Mardi McBrien is joining, and she is Senior Director for Corporate Performance and Accountability at the World Business Council for Sustainable Development. She's also Vice Chair of XBRL International, and formerly was pivotal in getting the International Sustainability Standards Board off the ground, having been the CEO of one of the initiatives that consolidated into the ISSB, the Climate Disclosure Standards Board, and then from there, Mardi was Chief of Strategic Affairs and Capacity Building for a couple of years. So wonderful to have you with us, Mardi, and we're going to be doing a little bit of a fireside chat shortly. But first, we're going to hear from David Harris. So David is Head of Sustainable Finance, Strategic Initiatives and Partnerships at the London Stock Exchange Group. He's also involved in a vast number of initiatives in the sustainability and transition space. He was part of the Transition Plan Task Force in the UK and the Transition Finance Market Review. And he's very involved in a lot of the work that is really driving us forward in terms of how businesses can respond and contribute to the global climate transition. For my part, Mark Manning, I'm a former regulator, spent many years at the Bank of England, Reserve Bank of Australia, and Financial Conduct Authority, and in that latter role, led on sustainable finance regulation and policy for the UK FCA. I'm now involved in a number of initiatives across the ecosystem, and am a visiting fellow with the London School of Economics. So without further ado, let's hear from David. So unfortunately, David can't be with us today, but he has pre-recorded a video for us. And when Mardi and I come back to do our fireside chat, we'll refer to a number of the themes that David will be speaking to over the next 15 minutes. So let's hear from David on the screen now. Thank you.
Hello, everybody. I'm David Harris, Head of Sustainable Finance Strategic Initiatives at LSEG. It's a great pleasure to be with you. I'm going to provide a few thoughts, and then Mark and Mardi are going to pick up and have a broader discussion. Firstly, by way of context, let me just maybe explain my organisation, LSEG. So that stands for London Stock Exchange Group. We're well known for the exchange, London Stock Exchange, but we are a much broader, quite diversified financial markets, data and analytics business. So we came together with Refinitiv, which was the Thomson Reuters financial data business a few years ago. And but what that means is we also now, we work very deeply both with the corporate community, who are raising capital on our markets, but we're also working with the financial and investor community through the data feeds that we provide, the platforms that we provide to the financial sector, as well as the indexes like FTSE, through FTSE Russell, which is also part of the group. So that means that we bring a perspective both from a finance sector, but also from a corporate sector, and about how they're dealing with macro changes like climate change. Now, I'm going to cover off 4 questions. And and I'll give you some thoughts about each one. So I'm going to start off on kind of global geopolitics. Does that mean that there's been any changes in the way that investors are looking at climate change and the financial sector is looking at climate change? Secondly, I will look at how important is climate reporting and transition plans, and are investors using it, and how? I'll then my third area will be looking at the state of corporate climate reporting globally. And then finally, I'll cover how can we improve dialogue and information flow between companies and investors. So let me pick up the first of those. So given the global geopolitics, do investors still care about climate? My answer is yes, they do. At least many of the largest institutional investors. What we see is they're actually growing in sophistication in the way they are considering climate and building it into their financing investment strategies. And when you step back and think about it, it's not a surprise. The global implications of whether the world is on a 2-degree, a 3-degree, or a 4-degree trajectory of global temperature rise has massive implications, not only for obviously for people, for livelihoods, for ecosystems, but also for the global economy. We produce a report each year called the Net Zero Atlas. We produce it just before each global climate COP. Obviously, COP30 about to kick off in Brazil. We pulled out one particular chapter of that, which we've just published last week, which looks at physical risk. And often there's a focus around the impact around tropical countries. This actually looks at 8 OECD countries, including the US, and looks at what are the implications in terms of increased forest fires, flooding, extreme temperature, and how will that increase by 2050? And the impacts of that will be very significant in terms of these major weather events and how that affects a whole range of different industries as well as everybody else. So that's worth having a look at. But as well as thinking about the risks here and the risks on valuations, it's also important to think about this from an opportunity standpoint as well. Climate change represents an incredible level of industrial change that we're seeing around the world linked to the energy transition. And one way of looking at that is looking at the products and services that companies provide. We have a system called Green Revenues, which identifies 133 green microsectors. So this isn't just about renewables and advanced batteries, and this is also about like electric vehicles, but flood defense systems. This is about desalination technologies, a whole host of different products and services that provide those solutions. So if you try and break out that proportion of each company, so if it is 8% of revenues, that is advanced lighting, that is super efficient, we would take that 8% of that company's value. But that you can start to then add that up across a total market or across global equities. We call that the kind of the green economy. And if you treated that as an industry, it would be the second best performing industry after technology. The CAGR, the compound annual growth rate, is 15% versus 18% for technology over the last decade. So there's big opportunities here. Turning this actually though into some statistics, and what proportion of investors then are actually moving and acting on this. We do an annual survey. We've done it for a very long time, looking at asset owners. It's about the largest 300 asset owners globally that we typically respond. And about 5 years ago, we hit a point where over half of the asset owners were integrating sustainable investment into their investment strategies. Roll forward to a couple of years ago, we hit 70%. We're now well over 80%. So this isn't part of the market. This is the majority of the market. And the main sustainable investment focus area for them is climate. So this is a very important component of how institutional investors are looking at portfolios. We see that in changing demand for our own products and services. One of the main reasons why investors are switching indexes or benchmarks is to integrate climate. We've now just passed over 100 billion that tracks our climate transition indexes. The most recent was New York State Common Retirement Fund moved across another 2 billion just a few months ago. So this is a live area where investors are moving. So let's move on to the second question, which was how important is corporate climate reporting and transition plans, and exactly how are investors using it? So given everything I've just said, yes, this kind of reporting is really important. It's important that the information is consistent. So it does mean that at LSEG, we've been big supporters of ISSB, the International Sustainability Standards Board. We would like to see consistency around the world. That's why we came together with PRI, WBCSD, to call on governments around the world to get implementing ISSB by 2025. And we had over 120 exchanges, companies and investors calling for governments to do that. And we're now seeing that. So that's good news. The forward-looking information is also particularly important because that really also feeds into understanding how good a transition plan is. It's probably worth me just explaining how the financial sector look at that. So there's 4 different categories typically that they look for. One is around climate solutions, and I talked a little bit about those kind of solution industries. The second and third category gets called aligned and aligning. And this is looking at how good a company's transition plan is, and that is relevant across sectors. And then lastly is managed phase down, and that is more relevant for certain higher carbon sectors, which really need to phase down over time. The types of information that are used for each of those can be quite different, and it's slightly different for banks versus investors. But maybe I could use the prism of one of our climate indexes as a way to explain that a bit more. So an index investing is a way to invest across the whole market in an even way, where you're investing in companies based on their size. So they're higher their market cap, you're investing a bit more in them. Low ones with lower market caps, you're investing a bit less in. But that's to be able to invest in an even way across the whole economy. What these kind of climate transition indexes do is they overweight companies which are better positioned on climate, and they underweight companies which are less well positioned. So that might be on the solutions, overweighting companies with green products and services. Then on the transition bit, the aligned and the aligning, it is then looking at the quality of those transition plans. So that will be looking at a lot of that climate reporting or that forward-looking information to understand how good a company's transition plan is. Something which we do actually is, although we're collecting all that information, we work in partnership also with some academics at the London School of Economics. There's an initiative called TPI, the Transition Pathway Initiative, which was set up by a range of investors to get credible academic analysis on the state of transition and how good different companies' transition plans were, and looking at how quickly to decarbonize different industries would need to decarbonize, and therefore how good companies' targets and companies' progress matched up against those pathways. So we actually work quite a bit with TPI to build their analysis into looking at measuring the transition part. And then the last part, looking at the managed phase down, will then look at things like for certain sectors, for example, for fossil fuel companies, proven and probable reserves. It might look at whether or not they're continuing to try and do more exploration and production. And we'll also then build that into the analysis. But we'll then use those different factors to overweight or underweight companies. So that kind of information is hopefully that gives you a sense about how investors and the financial sector are looking and using that kind of information. Let me move on to the third question. So that was, what is the state of corporate reporting today? So I think there's some really good news here, actually. The state of corporate reporting has improved quite dramatically. When I look back to when I joined FTSE Russell back in 2002, when we were just after we launched FTSE for Good, one of the first sustainability indexes, a lot of companies weren't really reporting on that, on much of this. Today, that's very different. We actually, if you wanted to get some of the stats, we also recently published a report called Decarbonisation in Portfolio Benchmarks, and one of the great stats there was that now 65% of the world's largest companies. If you look at the largest 4,000, which is approximately the number of companies in the FTSE All World Index, if you look at those companies, 65% have now got climate targets, which is, I think, excellent. If we look at corporate emissions, then and looking at scope 1 and scope 2 reporting, and you look at that same universe of 4,000 largest listed companies, we find that 79% are reporting on their scope 1 and 2 emissions. That's 90% for developed markets. That is 68% for emerging markets. On the other hand, if we look at scope 3 emissions reporting, that is still an area where there's a lot of learning going on and still improvement required. Around half are reporting on scope 3. And if you look at that half of those 15 subcategories and where companies are meant to report on their most material categories, less than half are reporting on the most material categories. So that's an area where the improvement's still required. I still see a lot of frustration from companies around the complexity and the pace of reporting requirements coming at them. Hopefully things like in the EU with the omnibus and the simplification, that will help improve, but it also provides a challenge in terms of clarity about what's going to be required when. I think also companies are very unclear exactly how the financial community are really using the information that they report, and often feel underwhelmed by the number of investor questions they get on this. On the other hand, like we hear from the institutional investors about the fact that they would like to see companies going further and faster, would like to see better reporting, and we can see how they're shifting allocations. So there's a bit of a disconnect, and that brings me to my last point, which was what can be done to improve the flow of information and improve the dialogue and try and simplify some of this. So I wanted to come at that through the prism of transition plans. So this is obviously a new piece of a new area for many companies, and it can feel like an additional thing to report on. We see transition plans as a way to make reporting more efficient. It's a way of pulling out the most strategic, the forward-looking information, digesting that into something into a smaller document that you're not reporting on every year. It's more strategic in nature. And so that can then be stripped out from what is being reported on an annual basis where you can just cross-reference to it. But that provides a really useful document for engaging the financial community about your strategies in this space. So I think that can be a really effective way. I also think there's a need for companies to also try and reach out, not just to the sell-side analysts that are covering them, also to the asset managers, but also through them to the ultimate owners, to the asset owners and the pension funds, and to also engage them about the transition plans as they are the ultimate owners. So with that, let me wrap up. Do have a look at some of the resources I've mentioned, whether that's the Transition Pathway Initiative or some of the research that I mentioned. But I enjoy the rest of the event, and let me hand back now to Mardi and Mark.
Excellent. Well, some great observations and insights there from David. That was the first time I'd heard that. David and I talked about it before the event, but it's fantastic to hear the breadth of observations that he has talked through there. Mardi and I are now going to have a little bit of a conversation for the next 20 minutes or so. And while we're talking, please do feel free to add questions and observations in the chat, and we'll see if we can cover some of those off in our discussion as well. But to kick off then, Mardi, so, David has talked through how investors are becoming more sophisticated, how green investment is proving to be one of the most profitable areas for financial performance. He talked about the companies covered by London Stock Exchange Group's green revenues as being the second best performing industry if aggregated across all of those green revenues companies. He also talked about the growing importance of understanding physical risk and managing that as a business. So ultimately, investors really are going to increasingly be looking to those companies that are better protecting and enhancing value by taking climate considerations and other sustainability matters into account. Really positive messages there for how we can continue to make progress despite the geopolitical headwinds. Is that what you're seeing at WBCSD? And I wonder whether perhaps you could give give the audience a little bit of an intro to WBCSD, and then perhaps reflect on what the discussions with your members are revealing about some of these matters. Thank you.
Thanks, Mark, and also thanks to David for really setting us up well with always these very wise words. Hello, everyone, and thanks for joining us in this fabulous conversation. Mark and I could talk for well more than 20 minutes, so I'm going to try and keep it punchy. And if David was here as well, we'd have no chance. So what do we see? So WBCSD is a membership body, and we have over 260 of the world's largest companies all working together to pave the way and drive solutions and action on right across the sphere of sustainability issues you're tackling today. And we look at them through our sectors, through thematic areas, but also how we really radicalize and change and build sustainability and business as usual across all functions in business, and provide lots of education to support on that. And so we spend a lot of time talking to our members and listening to our members, understanding their problems and where they're going. Now, I joined here 3.5 months ago, as you alluded in your remarks, and I was expecting it all to be a big downbeat when I called the members, Mark. And, I called the US and I was expecting, oh no, and it's like, not business as usual, budgets haven't changed, just getting on with it. You call the next group in the next region, exactly the same thing. Same thing in Europe, and the action and the work is not changing. But to the point where David was talking about, we're hearing about the pace and the complexity of reporting requirements and the pace of change there. That is something that they are feeling at the moment. I think it's a bit of be careful what you wish for, Mark, because you and I have been in this game long enough to know, to remember back as also David aged himself unnecessarily then as well, going back to 2002. But we've been in this game long enough to remember when there might have been one requirement and we could probably repeat it word for word, and that was the one requirement globally, and then there was an explosion, and then everyone said, oh gosh, it'd be better if there was one. So you and I went and set up the ISSB with many others, and now we've got regulation, and everyone's like, oh, hang on, I don't know, I don't know. So be careful what you wish for, right? Because now we've got one or two good approaches. They're coming into regulation, they are being tightly looked at, and there is a real challenge in doing this well. We always knew this. And so now, we're very much supporting people to navigate what is now, again, a bit of it's not messy, but it's just a bit of a challenge. If you're in multiple jurisdictions, there's voluntary and mandatory frameworks, there's regulation, there's assurance requirements, like what do I do where? And so I think that's why, many of our members, with all the other issues they're tackling as well, are really starting to feel the pinch. So I'm pleased that David also cited that as something he's hearing from his issuers, along with, another area that we do hear a lot is aligning that, financial value with reporting. So reward for the work people are putting in. And again, we spent time working on that with David as well, but just a couple of areas. But I think it's actually more or less positive. And I think once we get through these first few pain point years of reporting globally, I think it'll be much better, and we'll be able to see the benefits, not just the whole. I think we've gone a bit from thinking I think we've gone a bit too far down just compliance route, if you like. And I think once we get through and understanding the sort of tick boxing compliance, we'll be able to take a step back and really see the strategic value in some of these requirements, and not as reporting obligations, but as tools that can help you think about how to drive value in the long run. And that goes for transition plans as well.
That's brilliant, Mardi. And we've had in the ISSB context, we often have this discussion around telling your sustainability story, putting a narrative together, using the common language of the standards, but basically using that to tell a strategic story. And it's fair to say, isn't it, that you can think of, if we think about transition plans and transition plan disclosure specifically, David ended on that note. At the end of the day, your transition plan is your blueprint to secure the company's continued relevance in a low emissions, climate resilient, just and nature positive future. So it's definitely a strategic tool. And if you can use that strategic tool effectively, both within your business and in communicating to investors, and get them, as you say, to reward the effort that you've put in, reward the action that you're taking and planning to take, that can be quite powerful, can't it?
Yeah.
Is that how your members are thinking about it?
Yeah, do you know what? I think it's a real mixed bunch because for some they're just getting started. You know, they've been voluntary. You know, they've been coming along. Some it's very much voluntary. You know, getting the hang of it, starting the work, looking for advice, looking for tools, looking for support in that. And we've got some, and I'll mention them a bit later. And you know, I always thought Europe was sort of leading the way here, Mark. But when you go to Asia, I mean, the streets out in front on some of this thinking and this planning, and I think that's really great. And you and I have been involved with the sort of transition plan task force, and you know, I always in my head thought these were standalone documents, and they linked back in. You know, as David was saying, you know, they connected back into the main reports and strategy. But some places they go, Marty, what are you talking about? It's just our strategy. We've already just built it in. We don't need a standalone transition plan. So you know, it's really good to see that people are really embracing it, and this is just BAU for people now, and it is part of their main communication to the capital markets. And it's built in. But equally, you know, I think it's just as valid to have a standalone, updated every couple of years, and always connected across into the mainstream filings as well. I think there's, you know, it's up to you who want to do that, but I think it's really good value. And those that are doing it well and really integrating it are seeing, you know, financial benefit. You know, Hong Kong real estate company I was talking to recently, who has just seen, you know, that pay off in spades through the cost of their insurance. Their premiums came right down. So, you know, you don't need to go much further than that to be convinced that the work does pay off.
Yeah, I think that's really interesting. So how can it unlock that value? You mentioned their insurance costs coming down, and that sort of argues for sort of thinking about some of that forward planning, not only in the context of mitigation, but also in the context of adaptation. You know, David talked about the rising physical risks, and that's a global phenomenon, not constrained to just a handful of economies. This is a global phenomenon, and you know, we're seeing that retreat of insurance. We're seeing that rising cost and lower availability or access to insurance. How can that be built effectively into that forward-looking transition planning, so that transition planning can be used as a tool not only to unlock finance to support your capital expenditure and you know, the transformation of your business, but also to build better defenses against physical climate risk? Is that something that you're thinking about at WBCSD?
We are, Mark, and again, we enjoy working with you on some of these projects, but a recent one that we have put out that again has had massive uptake in Asia really, really quickly was our CEO handbook on getting ahead on physical risk, which was all around transition planning and how we do that. And we sort of got in, you know, we listen to our companies, we go out, we interview them, that kind of thing. And we really understood that sort of corporate risk management was focused us on climate related transition risks, while the physical risks were being addressed through a much narrower scope around own assets and operations. So, you know, it missed that bigger network cascading effects that are cascading effects and impacts that are actually really important for business continuity and the value change. So, you know, we sort of to shine a light, if you like, bring that visibility across operations and finance, legal, reputation, all that kind of stuff. And build that in. And as I said, we launched it in Climate Week in New York, but did a roadshow in Asia beforehand. And I think I'm going to maybe slightly exaggerate and saying I think it's one of our most downloaded publications for this year, because it is just getting such, you know, it just hit the right sweet spot aimed at C-suite level and something they could access and understand. And I think that's that's really important. That's really important that we also think about when you and I and many others joining this call today are writing these guides and how-tos and reports, that we really think about the audience we're trying to hit with this and write it in a language and in a way that they can understand it and really act on it with the pace that we need. Now, Mark, I've just seen a 10-minute warning and I've done a lot of talking, so I think it might be time that I ask you a couple of questions.
Fair enough.
So, Mark, many companies' ambition seems to be constrained by dependencies on others in the ecosystem. And David's already talked about joining up companies and investors, and how that's been, critical as, finance is absolutely central to finance, to the transition. But as always, there's also important dependencies on suppliers, customers, and of course, policymakers. You did some work with WBCSD recently.
Thank you. Yes. This is one of the topics that I've been really thinking about lately. And ultimately, I think we need to understand that out in its transition plan is likely to require someone else in the ecosystem to do something, whether that's a supplier, whether that's a